as well. I mean, so it's a sideways lower start once again for all indices up there. 70 points is what that translates, that 0.25% cut translates into for the Nifty. Look at the Nifty heat map and we will take it from there. So what do we have? Bulk of everything is down, right? I mean, at least to begin with. It's an interesting day because tomorrow is a market holiday. There is the possibility of a tariff ruling later today. But, once bitten, twice shy, right? I mean, Friday we were in a similar kind of a position and then, of course, nothing happened. And Monday you had that big downtick. ONGC, Infosys, Coal India, etc. on the upside. On the downside, Aisha, Ultratech and Max Healthcare, which are the top losers. 60 points. So it's kind of tentative. It's not a washout, but it's a tough open. Rima.
Well, we've given up between yesterday and today. We've given up all of Monday's, rally that we had. So now week to date, we are absolutely flat. The Nifty's opened around the 25,690 mark. The level to watch will be at least yesterday's intraday low of 25,600, and prior to that, it was a low of below 25,500, 473. So that would be some markers. What's dragging us? Aisha Motors. I think there is a downgrade which has come through on Aisha Motors. So that is the top Nifty loser. You've got cuts coming through in Dr. Reddy's. The surge in crude prices is putting pressure on Asian Paints, HPCL, also weak in trade. TCS has lost 0.5%. In fact, oil marketing companies are weak in trade. HPCL, BPCL on the back foot today. In terms of IT, TCS, Wipro, Tech Mahindra weak in trade. Infosys ahead of numbers is seeing some buying, but again, no big gains, just up close to about 1/3 of a percentage point. On the way up, strength visible in ONGC, a beneficiary of the rise in crude prices. So ONGC is doing well. Coal India, NTPC, so PSUs actually on the front foot. For IT, it's a mixed bag because not just Infosys, even HCL Tech is holding up in the green. But all in all, it's a sort of a muted, lackluster kind of a trading start. No big fall to begin trade with. The advanced decline ratio also pretty much split right down the middle.
Well, that's right, Rima. A couple of stocks deserve attention. Polycab, there's a large trade that Nimish is alerting us about. So it'll be interesting to see who exactly were party to that transaction. As of now, we're putting close to around 0.5%. I think Nimish believes it's a little higher than that. So we'll try to get you clarity on that front. That stock is a little bit lower. Puravankara, I think I saw that quarterly update flash for our viewers on the screen. That looked pretty good and explains why Puravankara actually is bursting away up close to around 7.5%. Vedanta, Novama likes it, the bulls like it as well. The stock is up 1.5%. Remember, the stock has seen a big surge, but that continues its winning ways. And giving it company on the upside is Hindustan Copper as well as Hindustan Zinc. Now, one observation of the last few days is suddenly, some of these stocks are not ending at the high point of the day. They're actually coming off intraday. For the time being, Vedanta, Hindustan Zinc, Hindustan Copper, all of them open up with a good amount of green. Tourism, finance as well, that's one of the stocks that's actually trading on rather large volumes in today's trading session. So I think that one should come up for you on the screen. Net, number of stocks advancing and declining. A pattern in the middle, close to around 1,200 stocks apiece. The headline index is down. But the bulls, they'll be optimistic that with yesterday's low as a stop loss, we can see a bit of a recovery in today's trading session. For the time being, we're down 40 points out.
And it's, almost a clean split between winners and losers, 1:1 on the NSE. Almost down to the last stock, right? Let's just look at a few other names, right? So silver ETFs once again. Oh boy, I mean, I think it's just, it's become regular that, some of the top traded quotes, volume-led quotes on the NSE regularly now are silver E's. So silver B's 5%. And we should put this up at the bottom of the screen. The Tata Silver ETF, you've got HDFC Silver, SBI Silver. Across the board, it's all these silver ETFs doing phenomenally well. There, 4-5%. Just amazing. And this is after the phenomenal 150-160% rally that we've had in underlying silver prices last year. So it's a very, very strong start. What else, right? I think Vedanta, Nigel was highlighting earlier, it's up 1.7. The third top volume-led gainer. Hindustan Copper is up 1.7. So it's all, hard assets, commodities, base metals, and of course, precious metals as well. Keynes is up 1.25%. NetWeb is coming up with about a 1.25% gain. And HEG, Interarc, Builders, etc. You go down the list, but volumes start to fade away quickly. And that's where we are at. Rima?
Just Tata Elxsi, once again, that's down close to about 2%. Numbers are fine. The company's revenue has gone up by 3.2%. Margins have expanded. The company is talking about margins further expanding. But the problem for Tata Elxsi is the valuation. Valuations is close to 43 times forward multiple. And it's at a premium to companies like a KPIT Tech and even the others, Tata Tech. So valuations is capping the upside. Numbers per se are fine. And plus, as I said last week, the stock had an outsized rally. So maybe some profits are being booked on Tata Elxsi.
Tata Elxsi, by the way, is the #1 volume-led loser, by the way, Rima. So it's not on small volumes. I just want to highlight Hitachi, right? Power, it's down another 1% and had a bit of a bounce, but generally it's come off sharply from about almost 20,000 rupee levels a week ago. It's down to about under 17,000, 16,900 or so is where Hitachi is now trading at. So that's the other one. Federal Bank is down about 1.25%. Kalyan Jewelers is starting about 2% lower. L&T Finance is down about 1 1/3. So lots of stuff. Balaji Amines had a burst of energy recently. It's down about 2%. There is Kiri Industries. Yesterday was a big positive day after the collapse from the highs post-deal. It's down about 1.5% as well right now. So 20 points lower, tentative 25,700 is where we're at. Arvind Maheshwari is head of India equities at BofA Securities. Great to have you with us here, Arvind. Good morning. And since this is the first time we're speaking this year, happy 2026. I wish this is a better one. Arvind.
Thank you and wish you the same. Happy to be here.
Thanks very much. The only question, and I want to start with that, is how important is this thaw in relations between India and the US, and will we see something? What are you hearing from, your colleagues in Washington and elsewhere on how, actually in Washington, about how this is going to proceed? What are expectations like? I mean, what can you tell us, Arvind?
Well, at this point is anybody's guess, but we obviously we heard the US ambassador who's just taken on his post talk about progress on the talks. So that is definitely a relief. We call it disagreement between friends, and hopefully we'll find a resolution to this sooner rather than later. And in terms of what it means for the markets, obviously it's a big sentiment boost as and when the trade deal gets done. But ultimately, macro matters more. For any sustainable gains, we have to deliver growth. We have to see earnings come through. And ultimately, I think if we have to create long-term returns, that's where you will get the maximum sustainability, while this can create a temporary relief for the markets in terms of sentiment.
Arvind, so, and what's the view on earnings in that sense? Will third quarter deliver? We had Ramdeo Agrawal at our event yesterday who said, well, according to him, 350 companies that they track, the expectation is for a 20% growth. And he thinks that the fourth quarter, Jan to March, perhaps will be even better. I mean, of course, this is all in the realm of expectations. We'll see what the final delivery is. But what is your sense? Are you seeing first signs of a bit of a turn? Or not really?
Yeah, surely. I think after a couple of years of pedestrian mid-single-digit earnings growth, we think earnings this year is poised for a rebound. We should see about a 14% earnings growth this year, and which is how we are sanguine about the markets delivering a 12% return, mostly led by earnings. We think in terms of valuations at 21.5 times, we are already one standard deviation above historical average. So valuation-led upside is limited, but we think earnings growth is what is going to drive Nifty returns this year.
12% Nifty return, no valuation re-rating, but driven by earnings recovery. Arvind, hi, morning. This is Rima here. When you speak to foreign investors, are they willing to now bet on India after the kind of underperformance? And there is a possibility of a 12% return. As you articulated, there are earnings triggers on the horizon. Or they're still not convinced. And if we do get a trade deal. Will that be the trigger that pulls FI flows back into India, or even that won't be good enough because it's only a sentiment change?
So for foreign investors, obviously it's a global playground and a zero-sum game. Currently, I think we are seeing them continuing with their 2025 P&L generators. So you saw the tech theme, which is the AI, machine learning, semiconductors, all of that play out extremely well in 2025, and that story sort of continues right now. And markets that offer exposure, we are seeing that play out in Korea, in Taiwan, in Japan, in the Asian hemisphere. So you are seeing that that chase continue, and India, unfortunately, in the listed space at least, does not offer as much exposure. So the underperformance that happened in 2025 and sort of the foreign investment getting attracted to those markets, I think that will continue to happen for some time. That being said, I think the case for further underperformance for India is getting diminished with once earnings start to deliver. You're right that we should start to see some of this outflow pause or ease. Also, at the same time, we are expecting Fed to cut rates, weaker US dollar. That typically, in the if you look at historical examples, is typically an environment where we see emerging market rotation, money coming back into emerging markets, including India. So we should benefit from of that. So our base case this year is for foreign, while we don't expect a surge, we do expect the outflows to stop and, in fact, possibly see a marginal inflow this year.
Okay, all right. Hi, Arvind. Good to hear. So some marginal inflows will be good. And as you're mentioning, India in the near term could continue to relatively underperform. Hope I got that correct.
Yes, that's right.
All right. Arvind, the other big talking point is what more is in store for the Indian economy? Because you have the RBI, they have gone ahead and they have cut rates multiple times. From the central bank side, there has been GST rationalization and various other measures that have been taken. So we're a little lower on ammunition maybe than a few months ago. What more can maybe be done on the fisc or on the monetary front to pep up this economy? Because as of now, still things are softish.
Yeah, correct. I would agree. And I think some of this takes time to make its way through into the economy, into corporate earnings, et cetera, et cetera. So we got also the, once in a decade government pay hike, which should boost consumption this year. So all of this that you mentioned and maybe some more reforms that the government has in store. We have the upcoming budget on 1st of Feb and we'll see. But we think that there is definitely more that will come from the government side because it's very clear they are trying to push the growth agenda. And as these measures make its way into the economy and into the corporate bottom lines and earnings inflect, we should see investors starting to come back as bottom lines offer some support. The one area I think we do like is the earnings where the earnings visibility is higher and valuations leave room for upside. So which is the financials and the rate sensitive cyclicals, and which is something that we continue to push for. Premium consumption is another area. I think some of these areas you will create alpha on. I don't think we get a broadening of earnings immediately. That's probably a more FY27 story. But you will see pockets of alpha generation available for investors in this market even in the next 6 to 12 months.
Arvind, I mean, just to take a cue from another conversation with the AU Bank's promoter yesterday, right? I mean, I think you mentioned AI, etc., briefly, and there's not too much representation here in that sense. But there is one line of thinking which is that when it was about building out physical infra for AI, a lot of money has gone into it, and now slowly that will move away into adopters in the US and elsewhere. In India, of course, financials is seen as a big. I mean, anyone with large, sets of data, right, organized data, which can be leveraged using AI and other technologies. So AU essentially told us that with AI, with 50% less effort, they can scale, twice as fast. Is that it's not talked about that much at this point in time. Do you think that it'll become a bit of a boost, or it's going to be slow burn, slowly? I mean, this will start to show up across the financial space, banks and lenders mainly, to begin with.
Yeah, no, look, I think this is definitely becoming more topical and is part of conversations even globally, not just in India, is the practical use cases and who is really benefiting from all this AI spend. Currently, we are only focused on how much is being spent on AI infrastructure and creating that infrastructure. But ultimately, we will have to see where rubber hits the road in terms of who really is benefiting, where is value being created in the chain, and those are the guys who will benefit from it. So as this dust settles down, and it'll take a while, but I think it's still early days to find out. But there is already, we have talked about this for global banks, including obviously the Indian banks as well. Anybody, you're right, that there is an element of cost savings and growth push that can come with lesser resources as we start to get more and more use cases on AI. So there's definitely the case, but I don't think it is going to happen in 3-6 months. It's going to probably take longer before it starts to make a meaningful impact on bottom line.
But maybe if you like financials, because it's one of the few sectors where valuations are still reasonable. This is one more reason to.
Correct.
Or at least it's not a factor working against it, right? How much it will help, maybe a little bit longer.
Oh, absolutely.
Yeah.
Absolutely.
Got that. Arvind, great conversation. Thank you very much, and come back more often for these chats. Thank you. Okay, well, Dixon is what we're going to focus on next. Dixon was down about 5-6% yesterday. Phillip Capital has put out a note attributing some reasons for why the market's a little anxious about Dixon. Upasana has gone through that note. Upasana, take it away.
Well, concerns regarding the declining volumes from Motorola continue to cloud on the stock. Now, Phillip Capital has given a sell rating on this with a target price of 9,085 per share. It says that the volumes from Motorola, which is Dixon's largest client, has seen a decline of 20% on a year-on-year basis in Q3 FY26. Now, Dixon has the significant client dependence on Motorola, since 45% of its total revenue of FY25 comes from this single client, Motorola. Over the last couple of quarters, Motorola's volume have seen a sharp decline, which is why we saw the stock declining constantly since some time. And even remember that the Vivo JV approval is also pending, is what is concerning the investors. Now, for Q3 FY26, Dixon's volumes have been down due to key reasons that has been highlighted by the brokerage. It says that the Motorola has been facing strong competition from Apple, which has resulted in muted sales in Q3. And also the greater issue is the increased outsourcing to Carbon. Now, Motorola has outsourced nearly 23% of its volume to Carbon in Q3 FY26. Now, increased competition will result in declining volumes even further for Dixon from FY27 is what the brokerage believes. Hence, we can clearly see the sell rating on the stock.
Upasana, thank you very much for that. Well, what we're going to do is turn our focus back on that event that we held yesterday in Mumbai, the CNBC-TV18 Market Forum. And we had veterans across the fund management universe, people like Ramdev Agarwal, Manish Chukani, CIOs of top companies, top economists at our event. We will play out some of this stuff for you now and through the course of the day. So here is a bit from a veteran investor, Manish Chukani of Enam Holdings. And this is, of course, about the India-US trade deal troubles. Manish believes that there are two big powers in the world, US and China. Both want India firmly in their fold. India, of course, does not want to, and that is the right strategy in the long term, even though in the near term it may cause pain.
Two countries like this can't be at loggerheads for long.
Yeah.
But the fact is, we don't have too many things we can, hold someone to ransom for, unlike China, and therefore it's getting dragged on until, like I said in the beginning, you're kind of now in a world of a G2 where there are two big bullies, and you have to decide. You have to go in one camp. We don't want to go into either camp, and both of them are trying to, push us and prod us to fall into a camp. The better that we just stay out of these games that they're playing. And if it takes long, it's painful for the next 3 months, 6 months, 1 year, and for the companies and the individuals involved. But on a 10, 20-year cycle, I think what we're doing is the right thing, to stand with our position and what we need to do. So I'm not so concerned about how long it takes.
Well, Manish, also on, what's happening with AI, the big spending which is going into AI, and what it means for India in the current situation. It's a tough situation, but Manish believes that in this tough phase, lots of important companies will emerge out of India, and he hopes that this is a wake-up call. Listen in.
I've said this for a long time, that you asked him earlier about, do terminal values get affected? Of course they do. It's like, would you now be buying Indian IT services companies at high multiples? You won't, because there is a terminal value to that business. For example, what happened to broadcasting TV versus OTT? That there's a multiple which is going to collapse. Any disruption, the losers very well. For example, if EVs take over, what will happen to ICE engines and so on. So that disruption is certainly damaging for a number of businesses. We don't know the winners as yet. And by losing out in this AI business, forget the valuations, which may be bubble like today, but the business is real, like the internet was real. Now, my hope is that India is a beneficiary of the AI trade, because we use our data sets to find solutions which are unique to us. The way when the internet came, our types of businesses, financial services, for example, really benefited from it. We became a lot more global. We started having clients globally. Our research costs went down. So in the same vein, anyone with organized data sets, which is the next 2-3 year window of opportunity for our Indian companies to organize that. But what lies beyond that is how well we use this to get both efficiency as well as differentiation. So in that context, India is really falling behind in the technology space. But the way China took it as a wake-up call 10 years ago, when the first Trump presidency went hammer and tongs after them, and they realized that we need to stand up and create our own tech and our own markets and our own systems for doing things. I think that's a wake-up call we are going through today. The way it happened when we got hit with the first Pokhran explosions. And the next 2-3 years, actually, India woke up. I mean, the rise of what we did with ISRO and the defense industry really owes its origins to that period. I think this period will create a lot of important companies being born in India out of this need and this realization that we need to play our own game as well.
Well, on earnings, Manish says that 2026 is likely to be a tough year until earnings, come back into the mid-teens once again. He's bullish on what he's been bullish on for some time: financials, PSUs, hard assets, metals, etc. Listen in.
We spoke in Diwali, we spoke in December, so it's not changing because the calendar has changed.
Correct.
It is a tough year until earnings cross substantially double digits and come closer to mid-teens. People aren't going to come chase this market. Money has been going already to emerging markets from Korea all the way to Peru and Chile. The anti-US trade, in a way, has been on already. Metals have been doing well. Hard assets have been doing well. That trade continues. And I said even then that I would expect financials, hard assets, metals, and public sector, especially with the finance minister and the budget day now, a last big resource raising exercise is left is really from the PSUs. So these three would dominate this year in my sense. And if you make a double digit on the index, I'd be very, very happy. I would take it.
Okay, now to some views from veteran investor Ramdev Agarwal of Motilal Financial Services, who says that 2026 will be a better year as earnings cycle he believes is picking up for sure. He actually says that his universe of 350 companies is expected to grow earnings by some 20% in the third quarter. Autos, according to him, will be the star performer this year. Listen.
I think it will be better year because earnings cycle is turning for sure. Because I just saw the estimate from, we cover one of the largest number of companies here, 350 companies. So MO Universe, this quarter is expected to deliver 20% earnings growth. This is after 6 or 7 quarters, we are getting real upturn.
This
in
third
the
quarter,
earnings. Yeah.
20%.
Index itself could be about 8 to 10%, but all 350 companies put together will be about 20% aggregate. So let's see what comes out. And my sense is Q4 will be even better. So I'm very kind of optimistic on the earnings cycle turning up after brief, lull for last 4-5 quarters. And government is also after it. Now government is trying to put in place, slow down in the credit cycle, slow down in the, your credit cost. You are given fiscal benefit, you are given monetary benefit, you are given GST benefit. So government is firing all cylinders to get their nominal GDP growth going at 10-11% so they can collect taxes. They're not able to collect taxes. You see the tax collection, 2-3%, 4%. So they need to get to 12-14%. So now there is a vested interest of the government to reflect the economy to about 10-12% nominal. Hopefully with 4% inflation, it could be 7-8% kind of real GDP growth rate. That GDP growth is better than 7-8% now with nominal GDP growth of 8%, deflator being 0.5%. I think that doesn't fly in India. So I think we are again back to the old style, 7%, 7 plus 4 or something like that. So I'm optimistic that this will happen in next 12 months and which will push up the earnings cycle big time. As far as the sectors, I think large caps are better chance to beat the market than the mid and small. Second, I think PSUs still have a lot of steam. They are much more reasonably valued than private sector and earnings growth is almost 2x of private sector. So that looks to be a very interesting category. And I think financials, I think auto will be the star of the year.
All right, get into a break. On the other side, the management of Keystone Realty will join in on the back of the company's Q3 business update. Welcome back. Markets absolutely flat, so it's a good time then to begin our corporate radar. Keystone Realtors reported a 13% increase in terms of the volume, areas sold in Q3, signaling strong volume growth. But in terms of value, the pre-sales dipped 3%. So there was a divergence seen in volume versus value. The company's 9-month performance remains robust, with areas sold higher by 43%. We have with us the chairman and managing director of the company, Mr. Baman Rustam Irani. Thank you very much for joining in. Sometimes we say that the market stock price is an indicator of demand. It's a leading indicator. They perhaps know more. And realty has been a bit of an underperformer. And recently we heard about Signature Global, which is present in a different market, in the NCR market, but they highlighted demand concerns, the inability to meet the guidance that they had laid out earlier. So let's begin before we get into Q3 and Q4, etc. Is growth slowing down in any way in the Mumbai market, the areas that you operate in?
As much as I'd like to kind of answer that directly, let me just tell you that we are very much on path to achieve our 4,000 plus crores guidance. As a matter of fact, yes, quarter-on-quarter dip that you mentioned is not indicative of year-on-year growth. We are at 2676 crores of sales this year, which is roughly around 23% higher year-on-year. So we are well established in a beautiful city or in a beautiful area called MMR. I do not want to comment on the other markets, but what we can say about Rustamji is that we've chosen the right projects. We've been doing great amount of business development. We are an asset-light company. And my 4,000 crores, like I've said earlier also, I think that we will well surprise the markets by crossing this 4,000 crores by a huge margin this year. So I look forward to this last quarter of the year and announcing some great results. I also am very happy with the performance this year. I think I'll just quickly tell you, we've launched 5 projects, approximately 5,800 crores, which is about 83% of the guidance. And my business development, like I mentioned earlier, we've already crossed the 8,000 crore guidance in the first half year itself. So overall, we are on a good wicket. Mumbai MMR continues to hold its stead, and the markets are still very, very good.
Okay. And can you explain the divergence seen in Q3? Volumes up 3%, but value down. Sorry, volumes up 13%, value down 3%. What's changed in the portfolio to explain this?
It is a, like I mentioned, one should focus on overall performance, not on quarter. I really don't have a direct answer for you for that 3%, how the volumes go up, but that would just mean that we've been selling more of what is the government's Ladla, which is the affordable and mid-mass housing. You know, our project in Dombivli has done extremely well. Our Kasara projects have done extremely well. And it only means that launches of our new projects, which are in the upper markets or higher price markets, will be coming in this quarter.
All right. Hi, Baman. Morning and good to see you, Ben. So you're telling us the demand is as strong as what you were expecting?
MMR has been and will continue to be, Nigel, I mentioned this earlier, this 10-year run or 15-year run, we will see a few dips, which is always very good to remind all developers that nothing that goes up stays up forever. But at the same point of time, what I'd like to point out is Mumbai MMR continues to generate the greatest interest of all the markets that there are there in the country as of right now, by value and by volume. We've mentioned this before, that you have the highest sales. If you take Mumbai and Pune, it's almost 51% of the total sales of the country in terms of value of real estate, in terms of residential, recognized residential. So I see a strong run going ahead. We personally at Rustomjee are extremely happy to state that the walk-ins have been great. The number of sales that we've been doing have been great. The inquiries for our newer projects are great. So it just means that our policy of following the infrastructure wherever it is, and God bless this government, they've been giving us the best infrastructure growth this city has seen in the last, I would say, 70, 80 years. And very happy to be riding on this theory that this city will continue to grow, and we will be one of the proponents that will continue to have a greater footprint out here.
All right, Baman, is luxury doing well? Because there are signs that affordable housing is actually seeing a lot of pressure. Would that be a fair estimate?
You know, Nigel, affordable housing is a misnomer because the government calls it the 45 lakh rupee affordable housing. Whereas I'd like to state that anything under 1 crore, in the MMR, I mean, in Mumbai especially, and then in the MMR, anything under 75 lakhs is actually should be termed as affordable housing. You're aware that we do everything from 65, 70 lakh rupees, which is our Dombivli, our Kasara, and go all the way up to 150 plus crores, which is our Bandra sales. So we have the entire belt available. We do not see, I can state that again, we do not see a slowdown in any of these segments. But if you talk of purely affordable housing, there really is no project that I know of, and definitely not in my portfolio, which I can sell for under 45 lakhs today.
All right. And Baman, when you want something, it comes at a price. What about pricing? Do you think pricing is speaking out? I have a friend who has taken possession of one of the apartments that your company makes, and they were very pleased. However, pricing is something that, people are looking at very closely. Signs of weakness there or no signs at all?
I can tell you this, the Indian consumer, and especially the educated consumer, which is exactly the kind of people that we deal with, have always been value conscious and not really price conscious. So while, as you mentioned in your introduction itself, he is happy, and that is exactly what we look for. And if we were to just give lower prices, it would be with the help of the government, and the government has done this in the past. I can only state that premiums in Mumbai are extremely high, cost of construction is extremely high, the cost of doing business is huge. So Mumbai will continue to be, pricier than most of the other markets. I would love, and Nigel, you know this, I've said this in private conversations, I would love that, prices do not increase and volumes increase, because that is exactly what we are out to do. Increase the, volume of our sales, volume of our business, and then make our margins, at a steady state or a steady pace going forward.
All right, we'll leave the conversation here. Thank you very much for joining in. So Keystone Realtors saying that they're on track to beat their FY26 pre-sales guidance of 4,000 crore. Even in terms of launch pipeline, already in 9 months, they've achieved in excess of close to about 80,000. No signs of slowdown yet, at least in the MR region. The stock is down close to about 0.6%. We should pull up a one-year chart also of the stock. Dixon Tech is up 1.7%. We've got a gain coming through in Puravankara. That's the one reacting to the auto sales, to the numbers that came out for quarterly update. But let's move on now. ICICI Lombard is in focus on the back of the Q3 numbers. The net earned premium is up 12%, but the profit declined 9% on a year-on-year basis. To discuss the quarterly numbers, the outlook, we have with us Gopal Balchandran, CFO of the company. Thank you very much for joining in. The headline is that there is a rise of 12-13% in your premiums, but your net profit has declined. Can we talk about retail? Because retail has been the standout performer, very strong growth, but the losses have also widened. So what explains that? And what is on retail, what is the outlook going ahead?
Rima, good morning to you and to all your viewers in CNBC. Season's greetings first in terms of a good day to have this call. But having said that, let me kind of come back and put this in context. I think even in the past, I think what we have always maintained is to say that ICICI Lombard has always kind of stayed disciplined in terms of driving profitable growth. And hence, to that extent is something that has got exhibited even for this particular quarter. And to your specific point on some of the retail lines that cuts across motor and health, you're absolutely right. I think what we are quite enthused is with some of the reforms that got played out towards the end of the last quarter that has clearly kind of increased consumer demand on ground, whether you talk motor or whether you talk health. On both of these lines, from an ICICI Lombard standpoint, let me take the health piece first. Retail health, our market share for quarter 3, I think we are currently at about 4.5%. This number used to kind of largely hover around 3% levels in the previous years. Even on motor, I think in the first half, I think we didn't do as well. But if you were to see quarter 3, I think we have been able to substantially narrow down the gap vis-a-vis the industry growth numbers. And in line with what I talked about even last quarter, for the month of December, we have had an outperformance vis-a-vis the market of almost about close to 400 basis points. So hence, very, very excited. And we continue to maintain market leadership in motor as a line of business. To your point on profits, on an absolute basis, this is exactly what gets reflected whenever you start seeing very strong growth momentum coming back. In line with the accounting prescriptions, the growth earnings gets played out over the next 12 months or thereabout. But the cost of acquisition that you incur for sourcing the business is something that gets expensed upfront. And that's the reason why more than the absolute amount of profit as what is to look at, it will be better to look at more a sustained return on equity, which we have spoken about for ICICI Lombard to deliver between 18 to 20%.
Yeah, and that'll be good. That'll be great. Mr. Balachandran, good morning. Good to see you on the program again. Prashant here. But sir, you mentioned market leadership and rising, strong growth. But is there got to be a balance between rising costs, losses, etc.? I mean, is it coming at the expense of profitability across? I mean, if you see underwriting losses, actually a loss in the motor segment, retail, and these are important, the most important segments for you, right? So is this leadership coming at a very significant cost in that sense? And how long can you sustain it?
Thanks, Prashant, for kind of asking that. And let me again then put this in context, which is what I was kind of referring to. So one is whenever you see high periods of growth, which is what we are quite excited with from an ICICI Lombard standpoint, as I said, the cost is expensed upfront. So for example, in quarter 3, when ICICI Lombard has done very good growth, cutting across whether it's motor or health, my premiums gets earned over the next 12 months. Whereas my cost of acquisition that I incurred gets expensed out in this particular quarter in its entirety. That doesn't get deferred over the next 12-month period. So therefore, on an absolute basis, you will always see an outcome to that extent reflecting in terms of absolute underwriting losses showing an increase. But having said that, I think what we are equally mindful of is from an ICICI Lombard standpoint, that is something that you would have seen across quarters. We have always made sure that we kind of operate within the overall limit on expense of management that the regulator has laid down. And in the context of where we are on the profitability, let me again bring to light the industry numbers is something that we have for the half year. In motor, industry combined ratios for motor as we speak currently stands at 128% in the first half of the current year. ICICI Lombard's combined vis-a-vis that for the first half year was about 106.9%. So clearly we have had a huge delta vis-a-vis the market in terms of what we are underwriting at. And hence to that extent is where we stand in terms of our thought process of continuing to do prudent risk selection. And in the process, the point that I made, sustain an ROE in the range of 18 to 20%.
All right. Hi, sir. Morning and good to see you in. Since you mentioned about combined ratio, tell us what's the trajectory from here on? What do you end this year with? FY27, what should we be looking at this number?
So, Nigel, we have spoken about even in the past. I think the endeavor will be always to try and, as I said, continue delivering better on combined. But again, this has to be looked in the context of, let's say, how the industry is kind of positioned at. While I put out the numbers to the earlier point that Prashant had asked, even the overall combined ratios for the industry as a whole for the half year, if you were to see, has kind of moved significantly north from 113% to almost 119%. But from an ICICI Lombard standpoint, we continue to have that difference of more than 10% in the combined ratios that we have been kind of reflecting. So hence, to that extent, we will obviously continue to see how we can kind of do an improvement in our overall combined ratios. But more importantly, the earlier point that I made, to sustain that ROE of 18 to 20 that one would kind of look forward, whether it's Q4 or even for the matter of fact, as we head into the next year as well.
You've guided for a combined ratio of 102. Isn't that the medium-term goal? Do you get there in FY26 or does that get pushed forward to FY27 now, 102%?
Great question. So again, let me put this in context. I think as an industry, we have been going through various regulatory changes. We did have a change in the way the accounting prescription would happen for long-term policies. So hence, to that extent, that's the reason why even if you have looked at our investor script or for the matter of fact, investor presentation, we have called out numbers on both bases, which is the changed basis of 1 by n and also on an n basis. So if you were to stay focused on an n basis, because that is more reflective of the economic outcome of the book that one has underwritten, even for this Q3, if you would have seen, our combined ratios have actually improved. It was 102.3% in Q3 of last year. On an end basis, the combined ratio for ICICI Lombard in Q3 of this year has been 102.2%. And mind you, this is also a quarter where we also kind of took the full impact of the past service cost, resulting from, again, a very good reform in the context of labor code guidelines that got into existence. We had an impact of about 55 crores in the quarter. But to answer your point, I think directionally is what I kind of referred to. We would want to kind of see how we can continue to see our improvement in combined, but at the same time, try and continue to deliver a sustained ROE of 18 to 20%.
Mr. Balachandran, let me just go out of the third quarter syllabus for a bit, if you'll indulge me. We've been reporting extensively on over the last one and a half months about the fact that the government is very keen on insurance penetration. One of the things they feel is that insurance commissions paid out by insurers is too high. We put out a story yesterday that IRDAI is going to come out with a consultation paper on regulating commissions next month, this coming month. And what they're going to say is they're going to, it's going to contain proposals to cap commissions, lower commissions, and lower the overall EOM as well, the overall limit as well. So I just wanted to understand, because you mentioned that thing, right? I mean, premium is collected over a period, costs are expensed immediately. There was this one proposal where insurance companies had sent to IRDAI, or at least that was discussed, that deferring commission payouts instead of upfront do it over a period of time, and based on if the policy has to be continued for those payouts to happen, so it becomes dependent on that. Are these big changes? Will this make a lot of difference to insurance companies? I mean, how significant will some of these things be? I mean, I know this is what we reported, so I'm just asking you to respond to what we've reported. So just your view to that.
So again, Prashant, I think I'll just put this in context. I think one has to look at this in line with, let's say, what the IRDAI had done about a couple of years back. I think rightfully so, what they did was to kind of start getting every company to operate within a defined overall limit on expense of management, which is what I refer to as a company which is into multiple line of businesses. They have to run their overall costs at less than 30%. And ICICI Lombard as a company, I think we go back to any number of periods. I think we have always kind of made sure that we operated within the threshold. I think the key thing in line with, let's say, the thought process of where the regulators / various authorities are getting into is to make sure that the overall cost of insurance becomes affordable for the general
Understand that. My question is pointed. If commissions are lower and EOM itself is brought lower, will that make is that very meaningful as a change? And we understand the aim is to implement these from the 1st of April.
So, which is the point I was referring to, Prashant. I think directionally, these limits of expense of management is very, very positive. And the key will be to make sure that as a sector, we continue to kind of operate at levels which are lower on an aggregate basis. And that hence to that extent, I think we will be very, very, of course, we will kind of welcome any final report that gets kind of put out. But any guidelines which kind of says that insurance sector as a whole has to run within an overall expense of management limit within a threshold, we will definitely welcome that change.
Okay, you're not giving out much, but I'm sure you're noting our reportage, and maybe it is a big discussion point in the industry as we understand it. Thank you very much for joining us. We'll see what happens, and we'll request you to come back once we have that consultation paper. Then maybe we can, talk some specifics, etc.
More specifics around that, absolutely.
Thank you, Mr. Balachandran. All right, I think later today we have Infosys, which will be reporting third quarter numbers. So HCL Tech, TCS, now Infosys. What should we expect, Rima?
Well, expect a muted quarter, operationally at least. On the bottom line, the numbers that we have do not adjust for the new labor code and the provision that the company will take. So profits, as we've seen in the case of HCL Tech, TCS, Tata Elxsi, are likely to decline on account of that. But here are the numbers X of that. Revenue growth is seen flat on a sequential basis in Q3. This comes on the back of a 2.5% improvement seen in Q3 and Q4. In Q1 and Q2. But considering that the company gives you a guidance, you sort of have an indication of what they expect in Q3 and Q4. Margins are seen up 21.3%. Profits on an adjusted basis are also seen up nearly 1%. Now, the company had won a very large NHS order from UK, 1.2 billion euros. According to CLSA, some impact of that will flow through in Q4, but full quarter visibility of this deal win will happen only in Q4. In terms of the guidance, the full year guidance stands at 2 to 3%. The company is likely to narrow it. So usually when they start the year, more the uncertainty, broader the guidance. If it's a very uncertain year, they would give a 2 percentage point gap between the lower end and upper end. They started, current guidance stands at 2 to 3%. But now after Q3 numbers, there's only one quarter. So usually what the companies do is they narrow it. So 2.5 to 3% is what analysts expect. Margin guidance likely to remain unchanged at 20 to 22%. What will we watch? Well, last time the company said the retail is the weakest link. So, what is the update on that particular segment? Will the company also consider start sharing AI revenues details like HCL Tech does and TCS does? Clarity on technology spending for the upcoming calendar year, if there is any impact of the increase in the H-1B visa fee and the weighted selection process, which will be starting on the 27th of February. And then, of course, AI adoption and its impact on margin and pricing. But all in all, expect a steady sort of a number this time around. Vinay Rajani of HDFC Securities is now joining in for a quick technical check on the market. Vinay, quiet so far. What is the trade that you're recommending?
Yeah, good morning and thanks for having me on the show. So yes, market is trying to sustain at lower level and sustain at higher levels. And the day before yesterday's recovery was quite significant. Monday's low was around 25,473. That has become a strong support now. And it seems that market is into consolidation phase while some sectors are really outperforming, like metals have been performing well. So after precious metal, we can see industrial metals and base metals have started performing well. So sector specific, there is bullishness. Some PSU banks are really doing good. So that is going good. Now oil related stocks are doing good. So stock specific, sector specific, we are bullish on the market. On the upside, we see a strong resistance around 25,900, which happens to be the 50 days EMA for the Nifty. So we can say that we are in the consolidation between 25,500 to 25,900. So that's where we have to play, and sector specific, we have to take bullish bets. So these are the support and resistance. Once we take out the 50 days EMA, then there is a good chance of bullish momentum getting back into the Nifty. But till then, we can say that it is into overall consolidation.
Okay. In terms of specific trades, Vinay, what would you recommend?
Yeah, so as I said, the metal sector has been performing very well. Our previous recommendation was into Hindustan Copper, and that played out very well. And now we feel that the steel stocks can participate from here because we see some long-term chart breakout coming in the HRC, Chinese HRC, as well as the iron ore charts in the commodity markets. And that is ultimately positive sign for the steel stocks also, and we can see that strength building in the steel stocks from here. So Tata Steel is one of the stock which we like for the short term. Around 185 one can go long. I would suggest a stop loss at 181. On the upside, my immediate target should be 192. The second stock I would pick from the oil space related to crude. See, Chennai Petro is looking strong on the chart. So MRPL and Chennai Petro both have been moving up. So Oil India was my recommendation, but that has already moved up. So better to look at the stocks which are beneficiaries of this particular theme. So Chennai Petro in the cash segment looks good around 840 odd levels. One can go long. 820 should be the stop loss. On the upside, I'm expecting a target of 870.
Thank you, Vinay, for joining in. Get into a break. On the other side, Manisha Gupta will join in and talk commodities. So stay tuned.
Okay, welcome back. We'll shift focus to the commodity markets. Manisha is here with the top commodity on her mind. I mean, forget stocks. It's silver, it's copper and whatnot. Manisha, take it away.
Well, I have a list of top commodities, by the way, because there's so much movement here and so many of them making those all-time highs yet again. But I do want to start with silver because we're almost nudging that $90 an ounce mark. The COMEX futures in silver have already hit 90 and beyond. But we are looking at spot markets. Oh, okay. This is what you have. This is in 10 minutes, $91 an ounce on your screen. So this is an all-time highs yet again for the silver prices. We are trading 5% on the higher side right now. And silver is a space where you are looking at very strong fundamentals, strong speculative money coming in, lack of sellers, and then it also has been about, even with CME margin hikes, it really has led to those dips being bought into. In addition to that, you have China restricting exports from the 1st of January. Only 44 companies can export now, and China exports nearly 70 to 80% of global refined silver. So that is where the concern comes in from. And because of that, the silver lease rates are now standing at around 8% on a 1-month equivalent. So if you want to borrow silver for 1 month, you have to pay 8% on this amount there. Mexico, which is the largest producer of silver, has been looking at lower volumes and declining ore grades as well, in sense supporting silver prices therein. It also has to do with the very strong inflows of speculative money, as I said. That seems to be keeping the silver prices higher. There are only buyers and no sellers, and is the reason you're looking at an all-time high of 91 on your screens. 90 has been taken and quite easily in the Asian markets right now. Take a look at the gold prices. This is an all-time high yet again for gold prices. Support coming in from China buying gold for a 14th straight month for the month of December. Now, with the kind of buying that China has done in December, the total quantum in sense of Chinese holdings in sense of gold stands at 74.15 million ounces there. Gold also is looking at very strong ETF buying, physical buying. When you look at the ETF numbers in the global markets therein, it's a record high holding at $89 billion. If you look at that in quantum terms, well, that comes to almost 1,073 tons, which also is a 3-year highs. The central bank buying in last 3 years has been to the tune of 1,000 tons plus this year as well. You could be looking at numbers of 800 to 1,000 tons therein. And then this is the 3-month forecast that has come in from Citi overnight, which says that gold prices could be hitting $5,000 an ounce between now to 3 months. And silver, $100 an ounce seems to be a number that has come in from various banks who continue to reiterate higher follow-up revisions in sense of silver prices there. And then it is also about what is supporting precious metal prices. Well, the U.S. inflation data lowest since 2021 signals rate cut possibility. It also has to do with the Department of Justice inquiry tied to Fed Chair Jerome Powell. Autonomy of U.S. Fed is something that has been a concerning factor there. U.S. announcing 25% tariff on countries trading with Iran. It also has to do with U.S. saying that they could intervene in the unrest in Iran. U.S. also has the seizure of Venezuela's Maduro in a military raid. U.S. also is threatened to take control of Greenland. So half of the things really seem to be coming in from U.S. right now, which are supporting tangible commodities therein. It also is about attacks on 2 oil tankers near Caspian Pipe Consortium's Black Sea terminal, adding premium to prices there. I want to bring on screen on what we have done in this year until now for many of those commodities. And there you have it, clearly outperforming various other asset classes. So gold in last year gained up by 65%. It's already up 7% right now and trading at all-time highs. Silver prices 147% last year, 26% higher this year, trading at an all-time highs. Copper 42% last year, 7% up this year, trading at an all-time highs. Platinum, 125% of gains last year, 18% this year. We're trading at multi-year highs onto this one. And aluminum, after those 18% gains in last year, with 6.5% of gains, is trading at a 3-year highs. Tin as well, 18.5% of gains is trading at a 3-year highs. Zinc is trading at a 1-year highs. You have palladium prices trading very close to its 11-year highs with 17% of gains. And you have crude prices, 3 years of decline, but this year is 7% higher. So everything that you want to touch in commodities is trading at multi-year highs.
Absolutely. It's basically a completely crazy cycle we're seeing in some of these commodities, especially precious metals, but no less copper. By the way, some estimates say that copper is, just as an asset class, is seen for the most absolute highest amount of price return in 2026 compared to everything else. So that kind of tells you the mood with some of these commodities. Manisha, thank you very much for that. Time for a quick commercial break here. Lata will connect with the management of Bank of Maharashtra and she breaks down their third quarter earnings. So that's coming up in just a bit. Stay tuned.
Welcome to Earnings Central. Bank of Maharashtra rang in the banking results for the quarter with an outstanding set. Advances have grown nearly 20%. Net interest margins appear to have bottomed. They've risen slightly to 3.86%. And NPAs have fallen as they have been for the last several quarters. What's best? The bank's return on equity is probably the best in the sector at 23.8%. Joining me now is Mr. Nidhu Saxena, Managing Director and CEO of Bank of Maharashtra. Mr. Saxena, good morning. Happy Makar Sankranti to you and to all our viewers. You know, if you produce results like this, it becomes very difficult for a journalist to ask tough questions. But I'm going to begin with one issue that seems to stare. You know, your advances are growing far faster than your deposits. So loan deposit ratio has risen to 85. Is this a problem? I mean, how do you propose to tackle it?
Good morning and happy Makar Sankranti to you, to Lata, and all the viewers. Yes, LDR in my case has gone up to 85, rightly noted, but this is the global CD ratio. What has happened during this FY, we have started our IBU operations. In September 2025, we had 100 million. In December 2025, we have reached to 400 million, which is around 3,500 crores. So if you exclude this, the domestic CD ratio is 83%.
Okay.
And what we have done is, Lata, lot of bulk deposits, high-cost bulk deposits were allowed to leave the system, and we have relied on other alternate sources of raising resources. So we went, today my refinance outstanding is almost 17,900 crores. So if I exclude this, my CD ratio is standing at 78%. And I still have room to grow, because what we intend to do is to maintain our CD levels around 82, 83,
Okay.
where we think we have effective deployment of our resources and the maximization of the interest earning opportunity.
Okay. No, fair enough. I mean, there are banks with even 100 LDR, so you won't count as an outlier at all. But how do you see yourself tackling this? What kind of a guidance can you give us for advances? Will they continue at 20%? And therefore, what will deposits be?
If you recall the guidance for FY 25-26 that we shared in the beginning of the year, advances would be growing at 17%,
Yes.
what we said. But what is actually we are experiencing, like this GIFT IBU, over and above this, we are opening under a project we are calling Project 321. We are opening 321 branches in the period of 18 months. While I speak today, we have already made 116 branches functional in this FY. Now, let's appreciate that these branches, whatever business they are doing, base for them is zero. So whatever incrementally they are giving us, it is over and above the last year number is zero for them. So that's how I think, and this new branch expansion drive is going to continue for some time, and this will actually sustain the high double-digit growth both in the asset side and the liability side.
Okay. So you mean your deposits, deposits you had guided at 14%, you will do far better, you're saying?
Yes. So if you see this December quarter, advances of deposits have grown YOY 15%, within which the low-cost CASA has grown YOY 16%.
Yeah.
So our, if you see September 2025, our total deposits grew by 12%, within which the CASA grew by 15%.
Okay.
So focus is clearly on the low-cost component. The high-cost bulk deposit, it is just a matter of function of interest rates.
Fair
Today, I can easily decide to tweak my interest rates, and a lot of deposit will flow to the system.
Got
But
it.
we will grow our deposit book very mindfully, looking at how it is going to impact the bottom line.
Fair point.
We have other sources, refinance, infra bond raising. We will keep exploring these options to see that profitability, the business that is growing is a profitable one.
Okay. It's good to hear that you all are so mindful of all these other ways of raising money. Mr. Saxena, which brings me directly to margins, since you're speaking about cost of funds. You all have actually improved from the previous quarter, you know, from 3.85 to 3.86. This is despite one more rate cut coming. So can we say that 3.85 was your bottom, and now you're only going to see margins improve. Any guidance?
So when the rate cut cycle started in Feb 2025, we were mindful and looking at the numbers and calculations. Our calculation and the portfolio, which is linked to repo, was giving us a sense that around 18 to 19 bips contraction will happen in the NIM.
Yeah.
And by the third quarter, we were expecting, and most of our deposits had repriced with that. So we were feeling that there should not be any further contraction in NIM. And if all goes well, we should see probably some improvement. So 2 bips improvement has come in NIM. But I would like to maintain guidance number of 3.75, which we shared in the beginning of the year. Because there could be a rate cut further, and that will impact me along with other players in the system. But let's not forget that 3.75 also is a decent number, and I think we will like to maintain that number and achieve it also.
My sense is you are, playing very conservative and overachieving. I hope you won't give me the same answer for the ROA. Your return on assets, you had guided 1.75. You're already at 1.86. So can you guide us when we hit 2? This is a very good performance.
So, Lata, this is a journey which quarter on quarter we are trying to look at these ratios. What are the factors that contribute the numerator, the denominator? I only can say that we are mindful of these ratios. We should give the comfort to the markets that if they have reposed faith in the bank equity, they are getting the right positioning at right levels. So the point is, I will continue to maintain my guidance. Maybe conservative, yes, 1.75. But yes, I think the way we are growing, sooner or later, we may like to give a fresh set of numbers of guidance where ROA can be enhanced from what 1.75 that I have maintained for this year and even the last year.
Okay. Well, I guess it's important that you're playing very conservative. Let me come to your gold loans. Actually, all retail loans, 36%. I wanted to ask you if you can maintain this kind of a pace. But before I come to that, specifically gold loan risen by, it's almost doubled. What is the kind of LTV you are maintaining? Because a lot of analysts worry that if gold prices fall a bit, are you all still safe?
So if you ask me around 18, 20 months back, the gold portfolio we were having was around 7,500 to 8,000 crores. Today, along with co-lending, we have reached 22,000 crores. Minus co-lending, my gold loan that has happened through branches is around 17, 18,000 crores, and which is translating to that between 45 to 50% year-on-year growth, quarter-on-quarter. So this gold loan LTV, we are going as per the Reserve Bank of India guidelines. And we are also very mindful, conservative. We have, in fact, designed our products where my LTV is low. We are giving a price concession to the consumers. So they can pledge a gold, and if the loan requirement is lower, we will price that product at competitive lower price. So that's how we are also mindful that if what if the gold prices should come down, how it will impact my portfolio. We have a robust mechanism when we have increased this portfolio, robust mechanism to see that even at the account level, if there is any breach from the LTV on an ongoing basis. So we follow that very meticulously. And I think we are the kind of benefit gold loan as a product is giving. It comes with a zero risk weight. There is still a huge scope for banks to grow, is what I sense. And we are keeping this as a focus product. The only two things that we make sure before we allow even a branch to start doing gold loans is the purity check of the gold loan and safekeeping of the pledge tournaments. Once those two things are done, we go ahead and permit the branches to do gold loans.
I'm sorry I'm interrupting you, sir, because I'm trying to pack in probably half an hour of questions in the 10, 12 minutes given to me. But this one I have to ask you, because you're the first bank announcing numbers. Was there any impact of the labor codes?
So, while we are mindful, the code has come, some rules are under framing, but whatever has come, we have looked at those. impact in our case because my contractual staff strength is minimal. So we are not seeing any significant number to even share here. It's a very minuscule number that is coming as an impact of labor code. And I think we will keep, if more rules are coming, we are watching those. But to give you an answer, no major impact, no significant impact at all on Bank of Maharashtra on account of the new labor. And the reason is that my contractual versus the permanent payroll staff, it is minimal.
Okay. No, I get your point. Actually, the IT companies kind of put us on watch. Otherwise, we were not even preparing for this. Suddenly, the investor community is becoming aware that this can impact. It's good to hear that the first bank that's reporting numbers is saying that it's going to be a minuscule impact, as of now at least. A very quick last question, sir. You know, recoveries. Last year, you did 1375 crores. This year, you have already done 1044. Where do you end the year, you think? 1500?
So this is, I think, the number you have shared is recovery from the written off book.
Yes.
So what we are having a stock of almost 21,000 crores. And the last 2 years, we have, in a very focused manner, looked at recovering from the TWO book. And we have kept, because around out of 20,000 crores, around 8,500 crores are in NCLT at various stages. So at times you may not be very sure when the resolution will come and in which quarter. It may go to the next quarter while we expect this quarter. So we have kept a number of 1,200 crores to 1,500 crores annually to be recovering from TWO book for the next 4 to 5 years. And that number, once we have done, we have kept 2 special schemes where we are giving a NDND kind of a feature, non-discriminatory, non-discretionary, and we are able to resolve a lot of loan assets in the